Hi there, my name is Mark Cadman, one of the 4 partners of Link Property Services. Welcome to our Q4 wrap of the Sydney industrial market. Q4 is traditionally the busiest quarter of the year, with many companies looking closely at their accommodation requirements and, if in need of a change, trying to lock down negotiations prior to Christmas. With better than expected economic growth and infrastructure works booming in New South Wales, the outlook is positive and demand for accommodation buoyant, depending on the size range preferred. This year has been a little different though, with the supply of property extremely tight for both lease and purchase, making it difficult for some occupiers to find the right solution for their business. Supply in the sub 5,000 square metre leasing market is minimal across all Sydney markets, with demand very strong, allowing rental growth, lesser incentives and minimal letting up periods for landlords. The shift of power during negotiations is swinging back in favour of the landlord. We have not seen this happen for many years. Supply of industrial property in the 5,000 to 10,000 square metre size range is reasonable, particularly in the Western Sydney market, where demand is buoyant. Rentals have remained similar to past quarters, however incentives are decreasing, as are letting up periods. If supply tightens in this size range, rents will increase, giving landlords a much anticipated stronger return. Supply in the 10,000 square metre plus size range is broad, particularly given the pre-lease opportunities available, with demand in this size range thinner than one would expect. Rentals being achieved for existing buildings are generally 10% higher than those for pre-commitments, depending of course on the specifications of the buildings. Incentives remain at circa 10% for existing buildings, whereas more substantial incentives have been available for pre-commitments. The game changer this year has been the increase in capital values and land values. Demand for both investment and owner-occupier property remains incredibly strong, with very few opportunities coming to the market publicly. Some markets have experienced phenomenal growth, particularly South Sydney and the Central West markets. Values in these traditional strong markets with exceptional access to major infrastructure and amenity have increased in some cases by up to 50%, which we have not seen for the past decade. Yields continue to firm, with the cost of capital remaining low. However, banks are tightening their lending criteria. We expect 2018 to be a similar year to that of this year, with decision making perhaps becoming more urgent as the supply of property continues to decline and demand remaining strong. The strata market is back in force, and we will see several developments come out of the ground, with most developments pre-sold prior to construction completing. Finally, I take this opportunity on behalf of Link to thank our loyal client base for your continued support throughout 2017. Merry Christmas to you, and best wishes for a healthy and prosperous 2018.